Silver's the devil's metal, did what devil's metal usually does. It sucks you in, puts a high around 125, and I think it's going to languish between below these highs we put in this year, around 5,500 in gold and 125 in silver.
So to be clear, you see silver dropping to 50, and what do you see gold dropping to?
4,000 initially and potentially 3,000. Normal reversion of a bull market. The gold selling opportunity still potentially this year is of a lifetime. Supply demand stuff doesn't move much, but when price goes exponential, it shifts the supply, shifts the demand, it all moves over. And gold front run this. Gold gave you a great indicator that this was going to happen, this war or whatever. Silver's an industrial metal. Gold is higher volatility than S&P 500, and that's the problem. No, everything is linked to the stock market. That's just what happens. When beta goes down, all correlations go to 1.
How long before you think gold will peak again?
One thing about markets, it can really cause a lot of pain. It could make a new high, but I think the rally's over. That velocity of the rally, when you're able to accumulate gold and hold on, you make a little money.
So let's start with gold, because you are effectively arguing that the metals rally that we saw in the first quarter may have been a blow off top, not the start of a new bull cycle, as many would have hoped. So lay that out clearly for us, and let's start focusing quite heavily on gold. Let's get your outlook for gold.
So there's few times in a career you can say that you've sold or peaked or have an asset you were bullish on and it gets to a level that's the highest versus a 60-month moving average, the highest ever versus the Bloomberg Commodity Index, versus a 200-day moving average in 40 or so years, since 1980. So that's almost 50 years. It's very seldom you can make those statements. And that's the key theme about gold. Is I spoke to people in January and February I hadn't spoke to for decades. Most of us have been bullish gold forever. And the prudent thing was to just say, thank you, give it back to the market. So to me, gold told the gold selling opportunity still potentially this year is of a lifetime. And these things, how they always work is what you're supposed to be selling when they're yelling. The key theme though is now what's happened is gold switched from a traditional store of value when it traded at lower volatility, the S&P 500. Now 180-day volatility is over 2 times the S&P 500. So all that means is S&P 500 goes down, gold goes down harder. It's just the way it works. It's the way markets work.
When an asset hits a 50-year extreme against every major benchmark, history usually whispers exit, not accumulate. As Mike McGlone points out here, gold's move above its 60-month average and surge in volatility signals a regime shift, not stability. The uncomfortable truth is that gold behaving with twice the volatility of the S&P 500 turns it from a hedge into a risk amplifier, especially if equities correct into late 2026. Investors chasing safety may actually be loading into a more fragile position at the worst time. Next, Mike McGlone discusses why silver and broader metals may confirm this peak behavior.
Silver too. Silver's the devil's metal, did what devil's metal usually does. It sucks you in, puts a high around 125, and I think it's going to languish below these highs we put in this year, around 5,500 in gold and around 125 in silver, for years. That's just the way it usually works. The key theme is it's all the metals. It's copper. And so I'll go back to this. In 2016, 10 years ago, I started at Bloomberg, and I asked the index team to start an all metals index, partly because I've always been bullish metals. Metals are the best place to invest typically in commodities. You don't have contango backwardation to worry about. You don't have to, you typically have the best performance. You don't have to worry about storage typically, most notably in the precious. I've always loved the precious, gold, silver, platinum, palladium, but they just got too expensive. And that's the key thing to remember about all commodities. You have supply, demand, and price. Supply and demand don't move much, but price does. When price shifts exponentially like this, it shifts everything. And to me, that's what's happened. And it's also the way it happened. So the feeling I got in metals later last year, I was a little bit early calling for a peak, and certainly this year was very similar to what I saw in cryptos a year ago. It's classic peak bull market stuff. To me, gold basically front ran this event that happened this year. Last year's rally was wonderful. I got lucky to be on top of that one, but it was the best rally since 1979. It didn't make sense to me. Now it does. What's happened to Iran? Now, what's happened since Iran war? Gold's gone down. Most of the metals have gone down, partly as the world faces a potential global recession with crude oil. Doesn't make sense in gold typically, but all the industrial metals it does. That's top. And the key thing you have to think about going forward, let's talk about industrial metals. The thing that's really bothered me for a while is these deflationary forces you see in China. 1.82 in that 10-year. Now it's starting to matter. We see severe deflation, and now they're having problems exporting that to the rest of the world. And the other thing that really makes me bearish on the metals is how expensive the U.S. stock market was. 2.3 times GDP became the economy. It's still way too expensive. It's just starting to correct. So for things like the industrial metals to do well over the next who knows what period, the key theme you have to have is, first of all, you probably have to have the stock market going up. And I think we just started the first 50% drawdown, the third 50% drawdown since 2000.
The market loves calling it a super cycle, right before momentum quietly dies. As Mike McGlone points out here, exponential price moves in metals don't reflect stable demand. They distort it, often marking late cycle peaks rather than new beginnings. What's not being said loudly is that China's deflation and a 1.82% 10-year yield signal collapsing industrial demand, not expansion. At a US market still above 2x GDP and potentially entering a major drawdown cycle, and metals lose their macro tailwind fast. This isn't just about gold, it's a synchronized unwind risk. Next, Mike McGlone unravels why even strong macro narratives may fail from here.
There's good reason for that. Global energy crisis will do that. Highest prices in about 100 years will do that. And another thing you have to have for the metals to do well is China doing well. And China's facing a world that's heading towards recession. So metals gave you a great run. You're supposed to get out and say thank you is the way I see it.
Okay, I have a lot to break down over there. And I want to differentiate between the various metals, the industrials and gold. And let's focus on that. But just to clarify, you're saying that gold has peaked at what was just below 5,600, and you do not see it making a new all-time high, not just this year, but also next year. Not for what? How long before you think gold will peak again?
One thing about markets, it can really cause a lot of pain. It could make a new high, but I think the rally's over. That velocity of the rally, when you're able to accumulate gold and hold on, you make a little money. Let's remember what happened in gold is the time to buy almost any commodity. Now, gold's not really a commodity, but now it is because it's a high volatility. Is when it's kind of beat up and people don't really love it.
A powerful rally often ends not with panic, but with quiet overconfidence that it can't stop. As Mike McGlone points out here, gold's surge near 5,600 may reflect peak momentum rather than sustainable value, especially with recession signals building globally. The uncomfortable reality is that commodities historically perform best when unloved, not when they've already delivered outsized gains. If China slows further into 2026 and global growth contracts, demand-side pressure could override bullish narratives quickly. Investors holding for just a bit more upside often absorb the sharpest reversals. Next, Mike McGlone talks about how volatility and correlation are reshaping gold's role entirely.
The key theme I have to remember about gold is I took the pain. 2021, 22, and 23, I kept saying it was going above 2,000. I was wrong. And then it finally broke out. It gave us this good rally. You're not supposed to add to that trade. You don't want to tempt the market gods. So the bottom line is, I'd like to differentiate, but now they're all in the same bucket. That's the key thing. Silver's an industrial metal. Gold is higher volatility than S&P 500, and that's the problem. No, everything is linked to the stock market. That's just what happens. When beta goes down, all correlations go to 1. Typically, gold would do well, but remember what happened in 2008? It wasn't nearly as expensive as it is now relative to a 60-month moving average. So that's what's shifting. The key theme I've had for this year is all that volatility you saw in gold last year and this year, and all that volatility you've seen in crude oil this year, virtually never we have that kind of extreme volatility without it trickling over to the stock market, and that's just getting started in my view.
I definitely want to hit on the stock market and your call there. But again, let's focus a little bit more on gold here, because there's a lot of talk on price action. And what we could, in fact, be seeing, though, is a repricing, because we've also got major structural demand and changing fundamentals. And I just want to push back on you here politely, because we have inflation, currency debasement, de-dollarization, record bank central buying, an increasingly unstable global financial system, physical gold demand like we've never seen it before, increasing interest in gold as a settlement asset outside the dollar system. So we're looking at a very different macro backdrop right now. Again, to just expand on those ideas further, central banks have been buying more than 1,000 tons of gold annually for several years, one of the most aggressive accumulation phases on record. That is not speculative, that is sovereign reserve reallocation. So that would put a floor under gold, many would argue. And at this point, globally, central banks now hold more gold than dollar-denominated assets on average. And at the same time, we're seeing this clear shift towards de-dollarization. Countries are building alternative payment systems, settling trade in local currencies, in some cases using gold as that neutral settlement collateral.
The narrative says structural demand, but price action is starting to say late cycle exhaustion. As Mike McGlone points out here, once gold's volatility surpasses equities and correlations converge, it stops acting like protection and starts behaving like risk. What's quietly ignored is that even in 2008, gold wasn't this stretched relative to long-term averages, making today's setup far more fragile despite central bank buying. Yes, over 1,000 tons annually sounds bullish, but markets price forward, not backward. If liquidity tightens or equities roll over, gold may follow despite the story. Next, Mike McGlone discusses why these powerful macro tailwinds might already be fully priced in.
The macro picture is very different here. It's not cyclical, it's a structural shift that many argue we're seeing gold play in the system. And we're seeing more of that with this Iran conflict and oil trades and using yuan and gold as a collateral. We can get into more of that a little bit later, but we've also got a fiscal picture with the US crossing $39 trillion in debt, a period of sustained geopolitical tension. We know wars are expensive. Historically, they lead to more borrowing, more issuance, more printing, ultimately more pressure on fiat currencies, good for gold. And, that also feeds directly into what Wall Street dubbed the debasement trade last year, a dynamic of capital rotating out of fiat and sovereign debt into hard assets like gold as confidence in long-term currency value erodes. And we're seeing that, on the institutional level. I don't need to tell you this. Morgan Stanley, for example, discussed allocations as high as 20% to gold in portfolios. So many would say that position may not even be fully built yet, not even close. And then again, one other point here, the structure of the gold market itself has been changing.
The story sounds structurally bullish, but timing is where most investors get hurt. As Mike McGlone points out here, even with $39 trillion in US debt and rising geopolitical stress, markets often price these realities long before retail fully reacts. What's not being openly discussed is that institutional allocations, like Morgan Stanley's 20% gold idea, don't happen at peaks, but they also don't guarantee upside once consensus builds. When everyone agrees on debasement, it's often already embedded in price. For portfolios, that means risk is shifting from missing upside to absorbing downside. Next, Mike McGlone unravels whether these structural drivers are actually overstated.
In previous cycles, gold was largely driven by Western investors and ETF flows. Today, we have demand increasingly coming from, again, central banks, but also emerging markets, which are far less price sensitive, far more strategic. You've got a lot of gold accumulation in the East where they want physical gold. So, Mike, when you put all of that together, record central bank buying, de-dollarization, rising debt and deficits, debasement trade, fundamental shift in demand structure, a rise in physical delivery and demand, gold is a growing neutral reserve asset. To me, it's very difficult to reconcile that idea that gold has already peaked and is entering either a flat or sustained move lower. Are you effectively arguing that these structural forces are going to be overridden by short-term cyclical and technical factors, or are you saying that those structural drivers themselves are perhaps being overstated?
That was one of the best yeah buts I ever heard. We got to put that and save that one forever, Michelle, because that was awesome.
A powerful narrative doesn't guarantee profitable timing, especially when everyone agrees on it. As Mike McGlone points out here, structural demand from central banks and emerging markets may be real, but price still dictates outcomes in the short to medium term. The overlooked risk is that price-insensitive buyers don't prevent corrections. They often follow them, not lead them. Even with record accumulation, markets can stall or reverse if liquidity tightens into late 2026. Investors betting purely on macro themes may underestimate how quickly sentiment flips once momentum fades. Next, Mike McGlone discusses why even strong fundamentals failed to deliver for years before.
What you described was the key themes I used for about the last 5 years.
I'm quoting you in most of these. Exactly. This is when you're
And I was
arguing.
wrong. I was wrong for 3. I pointed it out. The thing I got lucky about was to point out gold was the #1 asset to rally last year, even beating Bitcoin. I got lucky with that, but it did. That's the key theme that I learned in my Ann Ike's macroeconomics course in 1982 in Illinois State University. You have supply, demand, and price. Supply demand stuff doesn't move much, but when price goes exponential, it shifts the supply, shifts demand, it all moves over. And a key theme to think about here is gold front run this. Gold gave you a great indicator that this was going to happen, this war or whatever. Thank you very much. And now it's going the other way. The bottom line is lessons of history is sometimes markets are fundamental, sometimes they're technical, and things always peak with what you just said. It's a wonderful environment. In 1980, when gold peaked around 180, U.S. inflation was running, what was it, 15%? I mean, and that's nothing now.
Even the strongest macro arguments can fail for years before finally working and then overshooting. As Mike McGlone points out here, price, not narrative, ultimately dictates outcomes. And exponential moves tend to distort both supply and demand at the worst possible time. The uncomfortable truth is gold may have already front-run the very geopolitical and inflation fears investors are still reacting to in 2026. History shows peaks form when the story is strongest, not weakest, just like 1980 with 15% inflation. For investors, that means discipline matters more than conviction right now. Next, Mike McGlone talks about how past policy shifts crushed gold cycles.
That was a good reason to peak. And what happened? Everyone was bullish and it went down. That's top. I'm willing to put, I lost my hair, but I'm willing to put...
We had a Volcker there. Gold went down in the 1980s because we had a Paul Volcker who raised rates almost to 20%, making holding gold not the best environment. So you can't really, we're not going to see a Fed doing that now.
Well, the Fed's probably going to ease a lot as risk assets go down.
The exact opposite of the dynamic that we saw.
So, because typically it's look at the cycles, the lessons of books like The Price of a Time by Edward Chancellor and Boom and Bust by Quinn is we go through cycles. They're mostly inflationary and post-inflation deflation. And typically the inflation comes on the back of massive money pump. We had the biggest money pump in history in 2020 and 21. That's why McGlone was so bullish gold and Bitcoin. Poof, that's ending now. Stock market's too high, gold's too high. We've seen the rally. Everything you said was stuff that's happened. Now I have to look forward.
Everyone remembers the rally, but few respect what ends it. Policy shifts and liquidity reversals. As Mike McGlone points out here, even without a Volcker-style 20% rate shock, the massive money expansion of 2020 to 2021 has already done its job in pushing assets higher. What's not being emphasized is that once that liquidity wave fades, markets don't stay elevated, they mean revert, often aggressively. With both stocks and gold stretched simultaneously, diversification may not protect portfolios the way investors expect. The real risk is synchronized downside across asset classes. Next, Mike McGlone unravels how geopolitical assumptions could be misread entirely.
So let's look at the geopolitical part of gold. Part of the reason I was really bullish gold started with the unlimited friendship. Well, that started, but that was something that really accelerated in 2022 between President Xi and President Putin. Now, what have they lost so far? They've lost Syria. They're bogged down into this almost 5-year war in the Ukraine. They've lost Venezuela. Iran's just a matter of time, and Cuba's next. You see what's happening is also in de-dollarization. Let's look over at cryptocurrencies. De-dollarization is kind of silly. Where are you going to go? You can go to the yuan. You can try a BRIC currency. You want to use the euro? Well, good luck. They don't have 11 aircraft carrier battle groups. That's proving it right now. Yeah, it's a little bit of a battle of bulge right now in Iran, but U.S. will clean that up. The bottom line is what you see happening in cryptos. The most significant development in cryptos is the proliferation of crypto dollars. 90% of all the crypto dollars or crypto stablecoins track the dollar.
Everyone talks de-dollarization, but the plumbing of the system tells a completely different story. As Mike McGlone points out here, even in crypto, supposedly the alternative, Around 90% of stablecoins still track the US dollar, reinforcing its dominance beneath the surface. The geopolitical losses he outlines challenge the narrative that a new monetary order is replacing the dollar anytime soon. What's not being said is that global trade, military power, and liquidity networks still anchor the system firmly to USD. Investors betting aggressively against the dollar may be early by years. Next, Mike McGlone unravels how this ties directly into gold's potential downside.
Why? They haven't organically, because it's the only place to go. I mean, and globally, people will trade cryptos in dollars. Why? Because it's the base currency on the planet. So I'm not worried about that. I just like to point out it's just a little lesson in life. When gold goes to 2 times its 60-month moving average, you better be a seller. Bottom line is, markets prices have shifted, they went exponential, and everything you said has been priced in, and all that demand and supply stuff, even central banks are going to flip on the other way, just the way it usually works, question at a time. Now, I'm not saying it's made a complete, I think it peaked, we can still get there, but these prices here, that rally we had for the last few years, that appreciation, the protection of your wealth is done, if history is a guide, for a decade.
So to be clear, you see silver dropping to 50?
Yeah.
And what do you see gold dropping to?
4,000 initially and potentially 3,000.
You see that as a new support level for gold, or a base?
It's just normal. It's just normal reversion of a bull market. Normal reversion. You look at maybe a 60-month average. Silver's old highs was 50. You should go back to those old highs. But it's a classic thing, Michelle. It's the classic saying you're supposed to be selling when you're yelling. And we had some of the best stretched markets in these ever in February. In January, silver was the highest ever versus crude oil and the highest ever versus copper. What was the right trade to do? Sell silver and buy crude oil.
This is where conviction quietly turns into risk most investors don't see coming. As Mike McGlone points out here, when gold stretches to twice its 60-month moving average, history suggests you're no longer early, you're late. The critical detail being overlooked is that exponential price moves often signal exhaustion, not strength, especially after the liquidity surge of 2020 to 2021. Even central banks, often seen as smart money, tend to follow trends rather than lead reversals. If gold drops toward $3,000 and silver revisits $50, portfolios heavily skewed to metals could face years of stagnation.